It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by consensuspicks.com.
Welcome to this edition of the TradingTips.com video newsletter. In this episode, we'll be looking at the Great Rotation. This is the ongoing flow of investor money out of bonds and into stocks. Will it continue, and what does it all mean? Without further ado, let's begin. Investors can hold their wealth in stocks, bonds, or cash. Business cycles typically encourage a rotation from bonds to stocks and then from stocks to bonds, but the unprecedented central bank intervention over the past 12 years has set the stage for the greatest rotation of this nature we've ever seen. A huge shift out of bonds that threatens to create an investment tidal wave. Can you ride this wave to profits, or is it going to sweep you out to sea? Investors began parking their wealth in cash at the end of July and the week ending August 2nd. And that's why stocks stalled out and actually hit their peak on exactly August 2nd. Investors were concerned that stocks were overbought, but that didn't make them want to stay in bonds. It seems like nothing could make investors want to stay in bonds. They look to be a virtually guaranteed losing proposition, and that's because of the relationship between bond yields and bond prices. When yields go up, prices must go down. And while there are no guarantees in investing, the notion that yields must indeed go up is about as close as you can get. Yields are determined by interest rates. Interest rates are determined by the supply of and demand for money. And while the demand for money is determined by the free market, supply is controlled by central banks. In the case of the U.S., we're talking about the Federal Reserve. The Federal Reserve is a nominally independent non-government body, but the federal government also influences interest rates and thus yields because of its budget deficits. And this all plays into the Great Rotation. The budget deficit is simply the difference between the amount of money the government takes in from taxes and how much it spends. The government needs to make up this difference somehow, and it does so by borrowing. The federal government issues bonds, and they're purchased at auction. Bidders bid, and what they bid determines and establishes the yield, because yield is a function of price. The federal government's debt is supposedly risk-free since the government can always pay its debts, supposedly. And because of this, yields on government debt establish a baseline for all other interest rates in the economy. The Federal Reserve purchases approximately 25% of government debt normally. In 2012, however, the Fed bought a whopping 61% of the debt issued by the federal government. The Fed is empowered with the ability to monetize debt. It essentially creates new money and puts it into the economy. With the Fed making so many purchases of U.S. government debt, interest rates are pushed down. The Fed bids up price, and when price goes up, yield goes down. As we know, short-term interest rates have been close to 0% for years now, and this just isn't sustainable. The Fed creates new money when it monetizes government debt, and eventually this has to lead to price inflation. And this is why the Fed has been talking about tapering its bond purchases to stave off this potential for inflation. And eventually the Fed is going to end its stimulus program. Obviously, the Fed's retreat from the bond market will cause the price of bonds to go down, and when price goes down, yields and interest rates go up. The Fed has announced its intentions. This isn't a secret. And this puts bondholders in a tricky position, but it puts the Fed in an even trickier position. How can it navigate through this maze and avoid a bond market meltdown that would have ramifications throughout the global economy? Bonds are seen as a safe haven, and last week saw the first weekly inflows into bond mutual funds for months. Obviously, people are concerned about the situation in Syria. This shows that even the Great Rotation is not a sure thing on a week-by-week basis. Traders can follow the flow of funds into and out of bond, stock, and money market mutual funds for signs of where the market is headed. It worked on August 2nd. This concludes this episode of the TradingTips.com video newsletter. Thanks for watching, and good trading.
This Trading Tips video newsletter has been brought to you by Consensus Picks. Each week, Wealthpire's Consensus Pick software scours through 800 plus financial sources to produce a short list of multi-verified stocks. Stocks chosen by more than one of the most accurate stock picking services. Then the Consensus Pick software automatically analyzes the short list of stocks using a series of proprietary filters, and it picks the single best stock out of the bunch. The Consensus Pick. Sign up today for Consensus Picks, and each week you'll be provided with the ultimate alert, a stock that's been independently selected by multiple stock picking resources. A true consensus pick. Visit consensuspicks.com to sign up today. View more Trading Tips videos. Visit tradingtips.com. Sign up for our free video newsletters and become a successful trader today.